Hey, what's up everyone? Hope you're having an awesome day. Sam with the Humble Outliers, and today's video is on how to invest like Warren Buffett and 5 simple investing principles you can learn from Warren Buffett. Before we start, please smash that like button down below for the YouTube algorithm and hit that subscribe button. I'd love to hit 100 subscribers by the end of February. Thanks and much appreciated. So little to no introduction needed. Warren Buffett, he's one of the most successful investors of all time. His beliefs of value investing and the principles that he shares are some of the things that I think we can all learn from and become better investors. So this here article I'm going to go over is 5 principles and ways that we can learn from Warren Buffett so that we can incorporate in our own investing. I think some of these principles are just timeless classics that we should always know, and some things that we could just use a reminder on. I think we sometimes forget the basics. So let's go into and look at this article here. So when it comes to investing, beat the market is the goal above all. It means to produce a portfolio with higher returns that you'd receive by putting your money into a major market index, typically the S&P 500, and not just once. Beating the market doesn't refer to a lucky stock pick here and there. It means that your portfolio outperforms the S&P 500 consistently over a long period of time. Now this may seem obvious given that virtually every investor can access an index fund. Putting your money anywhere else means that you expect a higher rate of return. And that's true as far as expectations go for professional and retail investors alike. In fact, this is the sales pitch of every investment advisor on the market. They charge you a commission and promise that their guidance can earn you more. Almost every single one of them is wrong. In reality, only 5% of financial professionals can actually beat the market. For all but this lucky few, their clients would have made just as much money with fewer fees by going on E-Trade and buying an index fund. Warren Buffett is one of those few. He has made billions as one of the few investors who can actually produce results above and beyond the stock market's average rate of return growth. The Oracle of Omaha is a self-made billionaire who started investing when he was 11 years old. He is generally known as one of the best investors in the world. And while it's unlikely any of us will follow in his footsteps, it's possible and quite wise to bring some of his principles into your own portfolio. The first principle is buy businesses, not stocks. Most investors start their process by looking at the stock's price, its long-term trends, and its volatility history. In fact, just about all of the tools that professional investors use are built around formulas that take these quantitative values and spit out a result. This is important information to Buffett too, but he starts his process elsewhere, somewhere different. First and foremost, he looks at the underlying company. Buffett's approach to evaluate companies' fundamentals and what does its business model look like? How talented is its management team? What is its position in the market? Does it have a competitive moat, an advantage it can use that protect itself from potential rivals? All of this is critical information to an investor because while a stock ticker can tell you the company price, its fundamentals will tell you the company's value. And this is also really something that I look at too. When you're looking at a stock and a company, it's really easy to look at the sticker price and be like, oh wow, it's $500, $1,000, but really you should be looking at factors that I've learned along the way, such as the cash flow of the company, what that company is as its whole, what does it represent, what is its competitive moat in regards to the competition. Does it have a competitive advantage, such as a Coca-Cola, where people will most likely drink a Coca-Cola over a Pepsi, or Chipotle, where if you want a Mexican burrito, you'll probably go there as opposed to something like a Taco Bell, which is completely different. So those type of companies have I believe an intrinsic value assigned to it that can change, and also doesn't have really much of a price that you should be looking at. It's more so its true value. So the second principle is to buy what you know. According to Buffett, he invests only in companies that he understands. This goes hand in hand with the first rule. You can't get to know a business unless you understand how it works. What does this company do to make its money? How does the industry as a whole work? This doesn't mean that you need to master the details of a business model, but it means you should make sure you know this industry well enough to tell the difference between a good business and one that looks just good on paper. So with principle 2, it's buying what you know. I think this is important because at times, we kind of get trapped into what's the buzzy stocks, what are the ones that have, really good dividend payouts, and, there may be a price drop, so you want to, go after that stock. But I think really it comes down to making sure when you're buying a stock, you understand its business, you understand the fundamentals. I typically only buy stocks where I really understand, how they get their money, who's running that business, who are their competitors, and then what type of potential growth still lays out there. So a company I'm buying a lot of is Microsoft more recently, and that's because I understand, its business model, which is right now it's cloud business, and also its service businesses, business sectors. And then if you look at their earnings reports, you can kind of get an idea of where their business is split. And based on that, I believe that this company still has plenty of room to grow, especially with the cloud business and competing with Amazon's web service. So let's look at principle 3, the buy and hold. Increasingly, few investors buy for the long term. For many professionals and even individuals, investing has become more like a video game. You don't sit in one place all day, you move and react with the market. This feels satisfying. You are actively managing your money. It is also not what Warren Buffett does. There are many versions of this advice. Buffett warns against speculation, the practice of grabbing a stock and hoping that its price will soar. He warns investors to focus on a business's long-term potential, not the jitters of its day-to-day price. And he advises that investors plan their stock purchases for the long term. When looking for an investment, find one that you will have for several years, not one that you plan to flip in a few months. All of this comes down to the core lesson: buy and hold. Invest for the long term and select stocks based on businesses that you think will do well years from now. Don't waste your money trying to predict what the market will do in 4 months. Invest in your money in what you think your chosen company will do in 4 years or 14 or even longer. It's less interactive, but a whole lot more lucrative. This is something that I'm trying to incorporate myself. It's really easy, especially if you're someone that follows the market on a day-to-day basis or weekly basis, to, fall into the trap of, oh, this stock's on discount, or, I want to move my money here, or, this company's made some bad decisions here. I want to go buy this stock or sell this stock. Really, it comes down to just finding companies that you truly believe in, I believe, and buying and holding them for the long term. Some examples of this success I've had was buying Apple stock at 160 a couple years ago and holding on. And the reason I did that was because I knew its business. I knew I knew where the growth sectors were still going. I knew that the iPhone device sales may have slowed down, but they've definitely made improvements in, the device wearables and also their service business. Another one is Microsoft. I bought them when they were only $90 a share, and I've held them for this long. And it's because of its business sector, its cloud business, and all these factors that I still see there's a lot of opportunity for growth. And I try to not look at what's going on and react to the market. I just buy and hold. If there's a dip, I'll add more shares. And I look at companies that I trust for the long haul and believe in with management and the direction of the business. Principle 4. Don't invest emotionally. It is common, surprisingly so, for investors to react emotionally to changes in the market. This is often a trigger behind short-term trading. A stock will unexpectedly dip, perhaps, and spooked investors bail out. A sector will look exciting and investors dive in motivated by a rush of greed and FOMO. This is not a great idea, according to Buffett. Make and stick to disciplined plans when it comes to your portfolio. Choose new stocks wisely, not on what seems trendy or cool, but based on solid metrics and performance. Sell a company when you think it has exhausted its value to you, not because it suddenly seems scary. Be willing to change your plans, but do so based on a rational analysis of business fundamentals, not because things feel different. Gut calls and instinct are for investors on TV. And if you don't see anything worth buying right now, then sit still. Don't let yourself get spooked into feeling that you need to add something to your portfolio for the sake of it. Cash is a perfectly fine position until the right investment comes along. This is also an area where it's really easy to get emotionally involved and see what's going on in the market and fear FOMO. Also, all negative, sometimes press, analysts, giving negative feedback about certain stocks. One that comes to mind is Tesla. When Tesla dropped all the way down to 160, it was really driven by short sellers and also the market as a whole, just analysts really just bashing the stock. If you had just held on that stock at the 160 to 200 range and you didn't sell, you just didn't look at it, you just trusted the business, you saw what the direction of the company was going, and you held on, you would have, doubled, tripled your money by now, because the stock's over $600 a share. So it really just shows you that in being emotionally involved in your stocks is not always the best way to invest. It's really like the principle says, is just to not look at things from an emotional standpoint and look at the solid business metrics and the research you have done on your stock, and then trust your decision and let it ride out for the long term of a buy and hold situation and see where it can go, and add to it when you see things dip. Principle 5, buy when they're selling, sell when they buy. Finally, Buffett suggests that you should manage your portfolio against the market. What this means is that you should move in a counter cycle to how other investors are acting. When the market is caught up in a rush of sales, that's the right time to start buying. Prices are low and good companies are probably undervalued. During bull markets, when other investors are buying and pushing prices up, that's when you should sell. This is in many ways the capstone of his other advice. Market trends are often formed by investors behaving emotionally or protecting short-term positions at the expense of long-term gains. During a downturn, investors unload stocks quickly, hoping to net some value even if it means taking a loss. That's fine if your goal is to protect your assets tomorrow, but if you're investing for 3 years from now, plan for the long run and don't worry about what the market is doing right now. After all, your goal is to beat its results anyways. And this is true because in 2018, the market in December of 2018 really dropped. It just really spiked down, and you could have got Amazon for $1,300 a share. Many different stocks just plummeted. The market as in general plummeted, and it was due to many different factors. The Fed, with the Trump administration, all these types of things. Had you been greedy during that time and you knew that the long-term game of the market is your plan, then if you would have bought those companies that you really liked, that you were really looking at, that you knew had tremendous opportunity, you bought those companies at the dip during that point and just waited out, you would have had tremendous gains, 40%, 50%, 100% gains. And it really tells you that, cash is not a bad position if you don't see any true good discounts out there or any stocks that you feel that the value is correct. One of the things is that just being able to look at the market, assess it, and when people are selling and the prices drop, that might be a great opportunity for you to get in there and buy a great company at a discount. And lastly, also, if you want to start building a portfolio like Warren Buffett, you can actually do so with as little as $10. By opening an account with M1 Finance using my link below, you will get $20 credited to your account to begin investing. M1 is the best place I've found for fractional investing, meaning you don't have to purchase whole shares to begin investing. M1 Finance is a great way to automate your investing and start diversifying your investing. You can build your own portfolio. You can copy my growth portfolio, or you can follow and mirror portfolios like Warren Buffett and others. As you can see here, this is the Berkshire Hathaway portfolio on M1 Finance. You can actually add this portfolio pie and start investing into it and mirroring it. And you can see that this is the performance of 1 year with the speculation of $100 deposit on it. So this is mirroring the Berkshire Hathaway Warren Buffett hedge fund portfolio. You can see a description of the portfolio here. This is the stocks in that portfolio: 26% in Apple, 13% in Bank of America. So it'll mirror your money allocation into that to match that. So if you were opening the account with the link, $20 would go and it would be split among these portfolios here, and it would divvy it up. Also, you could mirror my portfolio as well. So if you wanted to invest in my growth portfolio, this is showing I've got some different sectors set up, which is the tech and cloud pie, financials pie, REITs pie, and consumer spending pie. You can look into those by following my link and see what I've kind of selected as my stocks. But that'll wrap things up. So what's your guys' favorite principle of Warren Buffett when it comes to investing? I personally love his principles on buying companies of what you know and holding those investments for the long term. Thanks again for watching. See you all soon.